Welcome to another in the series of EPRA Mythbusters. The current backdrop of recession, high interest rates, high inflation and volatile capital markets has made us think much more about what the future may look like for European listed real estate. With that in mind, I have two specialist listed real estate fund managers with me from Premier Miton, fund managers Kirsty Riddle and Alex Ross, who have very clear views on what listed real estate might look like in the new real estate world. Kirsty, please could you take a moment to explain your fund and its strategy to put context around the discussion?
Sure, Matt. So we manage a Premier Miton Pan-European Property Share Fund, offering investors a liquid and diversified way to access high-quality real estate across the UK and Europe. We have a flexible investment mandate and can invest across all market capitalisations with a bias towards those smaller, more nimble property companies. And a key characteristic is our preference towards those management teams that can add value through real estate asset management initiatives. And, as we shall discuss, we think this will be an increasingly important dynamic for the listed sector going forwards.
One of the major advantages that we, EPRA the Association, and specialist investors such as you often talk about is the opportunity to take advantage of active management teams, as well as investing in long-term projects through a perpetual vehicle. Alex, please could you explain active management and the opportunity from your perspective?
Sure, thanks Matt. So just in terms of what we see going forward, there's obviously going to be a higher debt cost environment, a higher inflationary environment. And in that type of environment, what you need to see is growing the income. And the typical vehicle we've seen over the last decade or so has been more focused about just giving you a property income over a very cheap debt cost, very low interest rates. And we think that's got a lot less viability going forward. And going forward, what we're seeking is those management teams who can grow the income stream through active management. An example of that would be perhaps in the office market, where we have very high quality property management teams in the quoted sector whose DNA is ultimately always to try and look to improve office buildings. And that would typically be from secondary to prime. The opportunity we have in this next cycle going forward in this office market is to convert brown, gas guzzling, energy inefficient buildings to being those green, energy efficient buildings. And the reason why we think that is such a great value creation opportunity is there's going to be very limited investment demand and tenant demand to be in those poor quality, energy inefficient brown buildings, whilst we're seeing this structural demand from the major corporates who want to be in those high quality green buildings. So the opportunity here is the arbitrage to capture that value creation between buying very cheap, low capital value per square foot brown building, do your asset management, and then it ends up being a high demand from both investors and tenants green building. And the value creation is the gap between where you buy and where you then have that end value. So we see, amongst the quoted sector, the biggest attraction perhaps today is the quality of management teams we have in, for example, that office subsector where that is their DNA to create that value.
And Alex, how do you see the listed real estate sector growing in this environment?
Well, in a higher debt cost environment, we need more equity coming to real estate. And we think the real estate equities market is very well positioned to provide that equity. So what we call it the re-equitisation of real estate. And that re-equitisation, what we mean by that is more equity replacing debt. And we believe real estate equities are uniquely positioned to provide that equity to the underlying market. When we look back to 2007, 2009, after the global financial crisis, the REIT market didn't grow quite as much as we hoped. We saw some good growth, we saw some opportunity buying in the market, but perhaps not as much as we liked. And we think going forward, there's going to be quite a unique opportunity for the REIT market, particularly in the UK, where balance sheets are very strong, to acquire into private vehicles or private property companies which have probably got too much debt and need equity to come in. And we believe these real estate equities could be uniquely positioned to provide that equity going forward. So we think this is how the sector is likely to grow into this next cycle, and we hope that management teams will be alert to this opportunity.
Kirsty, what do you believe the current attractions of the European listed real estate sector are?
Equity markets have heavily discounted listed real estate shares to trade at deep discounts to asset values or high earnings yields due to uncertainty around interest rates and hence the outlook for property values, whilst private real estate is marked at the latest valuations. The benefits of liquidity are also becoming apparent in the listed sector again, as once again unlisted vehicles are being closed to redemptions in an uncertain market environment. Also in the short to medium term, the debt book of quoted REITs have a significant inherent value as a result of the significant portion of long-term interest rate hedging in place.
As a final point to wrap up, Alex, can you gaze into Premier Miton's crystal ball and look at over and above the active management opportunity?
So 2022 has been a very painful year, but going forward, we're given great encouragement by the favourable supply-demand imbalance in real estate. So for example, in the supply side, unlike all the previous downturns we've seen typically in real estate, are often caused by overdevelopment and oversupply. Whereas coming into this down cycle, there's been very limited oversupply of real estate. And even going forward, we expect that supply to get pulled back even further, because of course, as a result of the high inflation and higher construction costs, a lot of that future development is going to be unviable. And against that shortage of supply, we see some very good structural demand drivers. So, what we do see is that very good supply-demand imbalance, which ultimately comes back to where you get rental growth. And like I say, that this is a key driver we look for going forward in a higher inflationary, higher debt cost environment. You've got to grow the income. And that's where we see, the very positive outlook to real estate, which is why we think the sector comes back into favour for a lot of investors. And we think that will then come back into favour once we've seen this repricing of real estate play out. So, lower capital values, rising income, that should be a pretty positive environment for real estate going forward. Then you look at, again, as Kirsty mentioned earlier on, about the discounts to asset value of the quoted real estate sector, and you put that together in terms of the ability to buy real estate at a deep discount, and then you have an environment where the rent's going to start rising. We think will continue to rise, they're rising still, but there's good outlook to that rising income. We think that that's going to be a positive environment for real estate investors going forward.
Thank you, Kirsty. Thank you, Alex.
Thanks, Matt.
Thanks, Matt.
And thank you for watching.